I want to start with a number that Stanley Druckenmiller, one of the most successful macro investors in the history of financial markets, called one of the most dangerous structural decisions the United States Treasury has made in modern history. The number is 90. That is the percentage of all new United States government debt being issued at maturities of 2 years or less. 90%, not 20%, not 50%. 90% of the debt the United States government is currently adding to its balance sheet is being borrowed at short-term rates in instruments that will mature and require refinancing within 24 months. Druckenmiller's comparison was precise, and it was not flattering. He said this looks like what Latin American governments did before their debt crises, not as a metaphor. As a structural description of a financial engineering decision that has one consistent historical outcome when it collides with rising interest rates and a government that cannot reduce its borrowing needs. I have watched debt cycles in 40 countries over 40 years. And when I hear Stanley Druckenmiller use Latin America as his reference point for American fiscal management, I do not dismiss it as hyperbole. I ask what the arithmetic says. And the arithmetic of 90% short-term issuance against $36.2 trillion in total debt in an environment where rates remain elevated is the most important story in global finance right now. Let me show you exactly why. To understand why the 90% short-term issuance number is dangerous, you first need to understand why a government would make that choice in the first place, because it is not irrational on its face. Short-term debt costs less than long-term debt when the yield curve is normal, meaning when short-term rates are lower than long-term rates. A Treasury Department trying to minimize its immediate interest expense in a given fiscal year has a straightforward incentive to borrow short rather than long. You pay less interest today. The problem is tomorrow. When that short-term debt matures, you must refinance it at whatever rates prevail at that future date. If rates have risen, your refinancing cost increases. If rates have stayed the same, you have merely delayed the problem. And if you are simultaneously adding new debt on top of the maturing debt, as the United States has done every year for the past 2 decades without exception, the total stock of short-term debt requiring refinancing grows larger with every cycle. The United States is currently rolling over $9.2 trillion in maturing federal debt this fiscal year alone, $9.2 trillion. At current rates of 3.5 to 3.75%, the annual interest cost of that refinancing is already $1.03 trillion, more than the entire defense budget. If rates were 2 percentage points higher at the time of refinancing, the interest cost increases by $184 billion annually on that single tranche of debt. Compounded across multiple years of refinancing cycles, the arithmetic becomes what Druckenmiller called the Latin American trap. Not a risk, a trap. One that closes gradually and then suddenly. Now let me show you the Latin American parallel precisely because Druckenmiller did not choose that comparison randomly. In the late 1970s and early 1980s, several Latin American governments, most notably Mexico, Brazil, and Argentina, financed their growing fiscal deficits primarily through short-term dollar-denominated debt. The logic was the same as Washington's today. Short-term rates were lower, the immediate interest cost was more manageable, and the assumption embedded in the decision was that rates would remain stable or decline, making the rollover of short-term debt a manageable ongoing exercise. In August 1982, Mexico announced it could not service its external debt. Brazil followed, Argentina followed. The mechanism that triggered those crises was not a single catastrophic event. It was the Federal Reserve raising interest rates to 20% under Paul Volcker to fight American inflation, which caused the dollar to strengthen dramatically, which increased the real cost of dollar-denominated short-term debt for Latin American governments, whose revenues were denominated in local currencies, which made the rollover economics of their short-term debt structurally unworkable, which produced the sovereign debt crises that devastated an entire generation of Latin American economic development. The United States in 2026 is not Mexico in 1982. Its debt is denominated in its own currency. It controls its own central bank. It has the dollar's reserve currency status as a structural backstop. These are meaningful differences. But here is the structural similarity that Druckenmiller is pointing to. 90% short-term issuance means that the United States Treasury has concentrated an enormous percentage of its total refinancing risk into a short time window. Any sustained increase in interest rates, any loss of confidence in the short-term Treasury market, any external shock that drives yields higher at the moment of a large refinancing event creates a fiscal emergency on a timeline measured in months rather than years. The Latin American governments of 1982 did not choose to have a debt crisis. They chose to borrow short-term to minimize immediate costs, and they discovered that the flexibility they thought they had purchased was actually a concentration of risk that eliminated their ability to respond when conditions changed. That is the trap Druckenmiller is identifying, and the United States Treasury has placed 90% of its new issuance inside it. Now, I want to explain what Treasury QE is, because this is the second half of the story, and it is the part that connects the short-term debt structure directly to the gold market in ways that most investors have never been shown clearly. Treasury QE is not a term the Federal Reserve uses. It is a term that describes a program the Federal Reserve began in December 2025 without a press conference, without a formal announcement, and without using the phrase that would accurately characterize what it is doing. The Federal Reserve is currently purchasing $40 billion per month in short-term Treasury securities under the name Reserve Management Purchases. The stated purpose is to manage the composition of the Federal Reserve's balance sheet. The functional reality is that the Federal Reserve is creating new money from nothing and using it to purchase government debt that the private market is not absorbing fast enough at existing prices. That is the definition of debt monetization. That is what quantitative easing is. And in the context of a Treasury Department that is simultaneously issuing 90% of its new debt at short maturities, the Federal Reserve's $40 billion monthly purchase program serves a specific and consequential function. It provides a price-insensitive buyer for the short-term Treasury market at the exact moment when the volume of short-term issuance has reached levels that private market buyers are struggling to absorb without requiring significantly higher yields. Think about what that combination means mechanically. The Treasury is issuing enormous volumes of short-term debt. The private market's capacity to absorb that debt at current yields is constrained. The Federal Reserve is stepping in as a buyer at $40 billion per month to prevent the yield from rising to the level that would clear the market without its intervention. And the Federal Reserve is paying for those purchases by creating new money that did not exist before, new money that increases the total supply of dollars in circulation, new money that in sufficient quantity reduces the purchasing power of every existing dollar. That is the mechanism. That is what Treasury QE does. And gold, which has no money supply to expand, no balance sheet to monetize, and no printing press to operate, prices exactly that mechanism before the Federal Reserve acknowledges it by its accurate name. I want to give you the specific arithmetic of what happens to the short-term debt trap if the Federal Reserve is forced to cut rates in response to the economic deterioration I described in the context of stagflation, because this is where the two stories connect and where the outcome for gold becomes most clearly visible. If the Federal Reserve cuts rates in response to rising unemployment and collapsing GDP growth, the immediate effect on the short-term Treasury market is a reduction in yields. Short-term Treasury yields fall. This reduces the immediate refinancing cost of the $9.2 trillion rolling over this fiscal year. On the surface, this looks like relief. The trap appears to loosen. But here is what happens simultaneously when the Federal Reserve cuts rates into an inflationary environment. The real yield, the nominal yield minus the inflation rate, falls even faster than the nominal yield. When real yields are negative or near zero, The incentive for foreign investors and sovereign wealth funds to hold dollar-denominated short-term treasuries diminishes significantly. They are being paid a nominal return that does not compensate for the inflation that is eroding the purchasing power of their investment. When that incentive diminishes, foreign demand for short-term treasuries weakens. When foreign demand weakens, the Federal Reserve must increase its own purchases to prevent yields from rising despite the rate cut. And increasing Federal Reserve purchases means increasing money creation. Increasing money creation means increasing the money supply. Increasing the money supply in an inflationary environment means the inflation that prompted the rate cut in the first place does not resolve. It compounds. This is the loop that Druckenmiller is warning about, not a theoretical possibility, a mechanical consequence of the structural decision to concentrate 90% of new issuance in short maturities, at a moment when the Federal Reserve is simultaneously monetizing a portion of that issuance to prevent the yield from reflecting the true market price of the risk. Gold prices the loop before the loop completes. That is what it has done in every debt monetization cycle in the 3,000-year history of monetary systems that have confronted the same arithmetic. There are no exceptions in the historical record, none. Let me close by connecting the short-term debt trap directly to the two most important structural shifts in the global monetary system that are operating simultaneously with the Treasury's issuance decisions. The first is the accelerating move by foreign central banks out of dollar-denominated reserves and into gold. Central banks bought 1,037 tons of gold in 2023, 1,045 tons in 2024, and 863 tons in 2025. 3 consecutive years at double the historical average. The driver of that accumulation is not a preference for gold as an investment. It is a structural conclusion about the trajectory of dollar-denominated assets when the issuer of those assets is running 90% short-term financing, monetizing its own debt at $40 billion per month, and carrying $36.2 trillion in total obligations against a GDP that grew just 0.7% in the most recent quarter. The foreign central banks that are buying gold at double the historical average are not making a short-term trade. They are making a long-term structural decision about which assets preserve purchasing power in an environment where the world's reserve currency issuer is doing what Latin American governments did before their debt crises. The second structural shift is the growing recognition that the short-term debt trap has already begun to constrain the Federal Reserve's policy independence in ways that markets have not yet fully priced. When 90% of new issuance is short-term, the Federal Reserve cannot allow short-term yields to rise significantly without immediately increasing the refinancing cost of the Treasury's entire short-duration book. This creates a structural bias toward keeping short-term rates lower than the inflation environment would otherwise require, which is precisely the definition of financial repression. Financial repression, the policy of maintaining interest rates below the rate of inflation to reduce the real cost of government debt, has one consistent historical outcome for holders of dollar-denominated savings. Their purchasing power declines in real terms even as nominal values appear stable. And the assets that protect against financial repression are the same assets that have protected against it in every historical episode. Physical gold, physical silver, real assets whose value is not denominated in the currency being repressed. The short-term debt trap is not coming. It is here. The Treasury QE that is financing it is already running at $40 billion per month. The foreign central banks that understand its implications are already buying gold at double the historical average. Druckenmiller has already named the historical precedent. The investors who understand what those 3 facts mean together are not waiting for confirmation. Confirmation in debt monetization cycles never arrives before the structural move in gold has already begun. It arrives after. And in 40 years of watching these cycles, I have never seen the confirmation arrive early enough for the investor who needed it before they would act. Most investors are watching the daily treasury yield and the daily gold price. They are watching the output of the machine. Druckenmiller is watching the machine itself. Now, you know what he sees.